it's entirely predicated on the response to the economy. That's what caused it. That's what's going to quell it, right? The huge layoffs, the massive layoffs that everybody's talking about right now, e-commerce, tech, it's fragmented. It's not the economy as a whole. I think this leveling off of rates, it can't continue at the pace that it's been going at this year. We know that. So I think it makes sense that it's going to level off.
Welcome back to the Real Estate Syndicator Live, episode 20. And today I've got a very special guest, super excited to introduce you guys, if you don't already know him, to Eric Stewart, who we've known each other for many, many years, shared the stage quite a few times. He is the owner of Atlantic Investment Capital, and he's a commercial broker, originator, does commercial real estate loans and probably some other loans, but he has his pulse on the lending market. And what I love about the Facebook community is that we get real-time feedback. So if there's a topic that's on people's mind, that gets asked in the community, and people are always so gracious and adding value to each other. But that always gives us ideas of like, hey, this is obviously top of mind, which, you know, they probably shouldn't have taken a brain surgeon to figure that out. And so I quickly called my buddy Eric here, and on really short notice, he agreed to step in here and kind of give us a little bit of the lay of the land. As always, this is meant to be a Q&A. It's really for the members. And so we're going to start off a conversation, but please start gathering your questions, pop them in the chat, because I want to make sure that we're answering your specific questions. But Eric, take maybe 20, 30 seconds. Give us a little bit of your background. I know you're the commercial lending broker, but give us a little bit of your background and what makes you an expert here.
You know, you got it. Mauricio, thank you so much for giving me the time to and let me chat with everybody. I really appreciate it. It's never too short notice. You know, you say jump, I'm going to ask how high. So thanks. I appreciate it.
Appreciate it.
You know, I've had the good fortune of focusing on multifamily loans and multifamily investors since about 2004, 2005. That's really when I started to look at that. Prior to that, I was doing a lot of equipment leasing, doing a lot of business with the hotel industry in general. And then from there is where I started to shift into commercial loans. Well, in 2006, and you know, 2006, 2007 was kind of when my constituency of residential mortgage brokers who were sending a lot of commercial deals to me, they went away just because of the downturn in the market. And while I'd love to call it a genius business move, it was somewhat reactionary. That is when I started to focus on multifamily. That's where the leverage was. You know, Fannie was still putting out high leverage loans. And instead of focusing on, you know, the real estate broker, I really started to lean in to the individual investor. You know, that's where the need was. And so that was my goal, was to be a team member of the individual investor, rather than look for brokers. And, you know, it's those relationships that I've built have proven to be wonderful. I mean, and I think you and I have talked about this, Mauricio. I'm a little bit lazy in the social media aspect of it because of the real life relationships that I have. I need to really step up on my social game. But
you
yeah,
do. I know that you do. You absolutely do, my friend. I saw that your last LinkedIn post was like, you know, 2017 or something. Now it was about 2 months ago, but yeah, you've got so much value to add that would love to see a little bit more of you on social. And I didn't mention it at the beginning, but you know, you and I really know each other because you are actually, like you mentioned, doing the thing. You are a real estate syndicator. We've done, I don't know how many deals together, and you're actually in the trenches. Not only are you originating loans, you're actually raising capital, and you're a real estate syndicator, and a very, very successful one. So we kind of got the best of both worlds here. So I'm super happy about that. I've got a couple of questions that I wanted to start with, and then we'll open it up to the chat. Again, just post your question in the chat and then we'll get going that way. But even before that, why don't you give everyone kind of the lay of the land? You know, where do we stand today? You know, obviously interest rates, that's probably the big story or the headline story. But tell us where we are today. What does LTV look like? Talk about a little bit about, you know, the bridge and all that stuff. But where do we land today in terms of the lending world?
Okay, big picture. Let's go macro, and then we'll do some micro discussions once we drill down to the specific loans. Big picture. You and I were talking about how leverage has been dialed back. You know, there was a time when 80% loan to value was readily available, and programmatically, it still is. The programs are for perm debt are still there. Well, they will lend up to 80% loan to value. The difference is that we're proceeds driven, right? We're leverage constrained at 80%. They won't go any higher than that. But we're also proceeds driven. Why? Because the property has to make the payment. When we're talking about permanent debt, permanent financing, they're basing their decision on historical cash flow. That NOI line, right? That NOI line is our constant. So while cap rates have compressed and purchase prices have increased, now that 80% is a much higher number, and the properties just don't cash flow. So that was the driver behind what's creating that 65, 68, 70% leverage cap, is that we're proceeds driven. We're maxing out our available proceeds based on the cash flow. And this bump in rates that we've seen over the last 6 months has not helped that. But even prior to that, we saw a shift to bridge debt. Because bridge debt is that bridge lender is the one that acknowledges future income and is willing to step up into that capital stack a little higher. Well, now we get into this conversation that you and I were having before, and you know, something that was of heightened interest before the call was, you know, the term and the exit tests and what happens. But the big picture, that's where we are. Lenders are still, I mean, perm lenders, Fannie lenders, Freddie lenders, CMBS is tapping out at 75% like they always have. They're still there. We just need to find the deals that cash flow for that leverage in order to secure it.
No, and I'm glad you said that, because I was sort of interpreting that as the lenders are getting a little bit scared. They're not really comfortable lending at 80% anymore, because obviously prices have been skyrocketing. Cap rates have been compressed quite a bit over the last 6, 12, 18 months. And so I was seeing that as sort of a signal from the lending community saying, hey, we think this is getting a little too frothy. We're not willing to go loan on 80%. But what you're telling us is, no, the prices have gone up, but the sort of the cash flow and the debt service haven't really, the coverage ratio hasn't really kept up. And that's really the constraint, is really at that point, not necessarily the, you know, an adverse risk reaction from the lenders.
You know, and that's the beauty of having multiple fail safes, right? They have their leverage of 80%, but if they didn't have that debt service coverage ratio constraints, they'd walk right up there with them, right? But they want to see that 1.2 cover, and if the fundamentals were still there and cap rates stayed where they were, but it was true net operating income increase, the fundamentals were increasing, those lenders will go there all day long with you. They'll step right up. But because the cash flow stayed where it was and the valuations increased so fast, they couldn't justify going up there, and they still can't.
And how does that mesh with the fact that a lot, again, maybe it's not everywhere, but a lot of the markets are seeing ridiculous rent growth, right? We were talking about the Phoenix market right before we came on. I mean, that one, you know, they're projected 19% rent growth. I know in Florida, there's a lot of 30, 40% rent growth. I mean, California, I've got rent control, and my rent growth was crazy. So how is the rent growth not keeping up with the you know, the cash flow?
Well, two things. Rent growth, you've also got the expense growth, right? So the delta between the two isn't necessarily widening, right? You've got expenses increasing, so that NOI line is still relative with that rent growth, number one. Number two, the cap rate is based on that NOI line, right? And that cap rate compression still keeps going. So you feel the impact of the increased rents in the purchase price. It's anytime you're compressing that cap rate, you're widening that gap.
Makes perfect sense. Well, great. And so let's talk about that bridge, because the net results, you know, over the last 12 to 18 months of this issue of not being able to really get the permanent loans at the requisite LTVs, or at least LTVs that make it attractive to raise capital. It's kind of, I'm using the term forcing, but it's kind of forcing most real estate investors to go get bridge debt, right? And luckily, it's not the bridge debt I was seeing 5 or 6 years ago, which were like 18-month loans. So at least they're 3-year loans, and then there's a couple of 1-year extensions. I mean, I think the most popular one I keep seeing, and maybe that's the only one out there, is a 3+1+1. But there was some discussion that I wanted you to address in the community about, whether that additional, once you got to that 3-year, loan with those, number one, of those extensions automatic. I know we talked about that, but if you could just address that, are those automatic? And what should people be aware of after that 3-year? What are the potential pitfalls, I guess I'm looking at is, hey, you made it past the 3 years, but why shouldn't people think of this as a 5-year loan as opposed to a 3+1+1?
A great question. Definitely something that needs to be addressed, and it's easily overlooked. How many of us have had our loan docs sent to us, and we print out the signature pages, bang them out, notarize them, overnight them, and we have to hurry because they only send us the loan docs like 4 o'clock the day before closing, right? And they have to be in there. We're going to lose our earnest money if we don't close tomorrow. Everybody's been in that same situation, right? So we rush through the signing, and we hope that our attorney reviewed the docs well. So here's the situation. It's a 3-year term. That's the bottom line. It's 36-month term. And then as a fail-safe, we bake in 2 potential extensions. Now I say potential because there are caveats that are associated with those, but 2 extensions. They are negotiable up front. Let's say we want to lower the extension fee. Maybe they offer us a 6-month extension, and we want to bump that out to a year, but we'll pay a little bit more for the extension fee. It has a lot to do with our business plan. But those extensions those are there as an auxiliary. Those are there in case we need them. They're not there to be considered part of your regular term. Otherwise, they just call it a 60-month loan.
Right. And
Yeah.
those are all detailed ahead of time. Those are all negotiated. They're all in your loan agreement. So there's going to be no surprises. But I don't know how many read all the loan agreements, or they leave that up to the real estate attorney. But there are some things that can change, right, Eric, in year 4. Like if you actually avail yourself of the first extension, for example, there are things that may be triggered at that point if certain metrics aren't there.
You're absolutely right. Now, when we put this together, and this is all front end work, there's a definitive plan that you're going to discuss with your underwriters, with your lender, about how this is going to go, how you are going to force the appreciation of this asset, increase revenue, increase quality, and then stabilize the asset at this projected level to be able to refinance out. They are going to monitor, just like they do on your perm debt, they are going to monitor that property's performance and look at your budget, but not just at the time that you're making the request for the extension, but they're going to monitor that at a minimum annually, sometimes quarterly. That's baked into your loan docs too. So it's not like it's just at the extension request that you have to proof up how your property is doing, because they're not going to just let you sit there and then knock on your door in month 32 and say, hey, this is going to balloon in 4 months. How's it going, guys? They're monitoring this CapEx budget, how much you spent, how much you have left, what's been done. They're monitoring your cash flow. And just as an aside here, they look at your renovation budget, and you are going to commit to potentially have to rebalance that CapEx budget, say, I don't know, 18 months through your loan, maybe 12 months through your loan. You can negotiate that look period depending on what your schedule is. Like, hey, they could say, we want to potentially rebalance this or review this in a year. And you'll come back and say, look, my lease expiration schedule isn't going to allow me to get to this point in a year. Right. So then you can bump that out to 18 months and say, by 18 months, we'll have X number of units addressed and our cash flow will be here. And then at that time, you're going to go over that with your lender, and they're going to say, hey, this is what we have left. This is what you've spent. What have we done here? And then there's a potential rebalance in place.
Sorry, go ahead, Eric. Sorry, go ahead. Finish up. And that type of what?
Sure. That type of portfolio monitoring or maintenance, we should call it, every lender is going to do that. They've got to protect their portfolio and protect their exits.
And when you say rebalancing, maybe we're talking about adding additional capital into the project, correct?
Yes, sir.
Yeah.
It's going to be part of your carve-outs that you will put in the carve-outs that you're open to rebalancing this deal. If it means coughing up another 75 grand, 300 grand, replenishing that renovation budget to get you back on track because you spent too much money so far, that's part of that.
And how do most syndicators deal with that? Is that something the sponsors just kind of traditionally come out of pocket, if it's 75 grand, or is that something that they got to do a sort of a cash call or a secondary raise, or how do most syndicators, do you think, handle those additional capital requirements at the end of, once that 3-year term expires?
It's going to vary, depend. And let's say that to your point, even let's say the first year, if you have to rebalance it because of unknown expenses, it can happen at any point during your term. That is very specific to the syndicator, because as you know, and you've given me some wonderful guidance on this, we reserve the right to connect with investors and potentially dilute shares. We also make every effort not to do that. Right? That is not what we want to have to do with our investors. And if it means coming out of pocket for a couple $100 grand just to float things along and not have to dilute any shares and stress out those relationships, the value very well may be worth it.
Yeah, sure. All right. Well, good. Well, before we go on to the next topics that we have, I want to get into the chat here because as always, I want to make sure who cares what I want to know? It's all about what the community wants. So Jordan, do you want to unmute yourself? I know you had a question about attempting to assume a loan on a building. You want to unmute yourself and ask it?
Yeah. Thanks, Mauricio. I was underwriting a property that had what looked like an attractive loan assumption possibility down in the low 3s, but it only came out to about 50% of the asking price, and was going to have to add in some kind of supplemental loan because the returns just weren't there, raising that much capital to cover the difference. So I was wondering what kind of difficulty I might have finding a lender for a second position, and what kind of rate I might be looking at to do so.
Yeah, great question. You're not alone as far as folks that are looking to assume loans. We're seeing a lot of those. There are certain lenders that do not offer supplemental debt. So if you're working with Fannie Mae or Freddie Mac conventional, those are primarily where the sup loans are going to be available. And there's 2 big components that are going to decide whether or not you can get any kind of supplemental debt with those 2 shops. One is cash flow, right? You've got to be able to cash flow for the cumulative loan to value, the CLTV. It's not an automatic. At 50%, at 50% leverage, hopefully you'll be able to squeak out another 15% at a minimum, because that's 65% is a benchmark for them. Secondary financing, you're always going to be priced up. It's challenging to say where a sup loan would come in because it's somewhat deal specific. But right now, I don't think mid 6s for that second mortgage is going to be too far out of the range of where you would be. Now, take note of this too. Your remaining term has a lot to do with how high they'll go. Let's say the cash flow's there. Let's make that assumption that the cash flow's in place to support a sup loan up to 75% of your purchase price. But just to say, it's probably not, but let's say it is. If you have more than 84 months, if you have longer than 7 years left on that term, you should be able to go up to 75%, unless something's written into your loan docs that says you can't. If you have, say, between 84 months and 60 months, you should at least be able to go up to 65%. If you have less than 5 years remaining on that term, there's a chance that they're not going to offer you your supplemental loan. There's always a chance anyway, but there's a real good chance that they're not going to issue a supplemental loan to you. Programmatically, they wouldn't. You might get the exception. Knowing those leverage constraints, Now you have to be able to service the debt. And that's the challenge that we have on all of our new perm originations, is being able to service the debt.
Great answer. That answer your question, Jordan?
Yeah, that really helps. And in this case, it would be still over the 84 months left on the original loan. So that could be an option there.
Awesome.
Thank you.
Is it a Fannie or Freddie conventional? Because if it's Freddie small balance, they don't do sup loans.
I don't believe it was either Fannie or Freddie. I don't believe it was. I would need to double check on that.
Okay, because if it's a CMBS deal, no sup. Freddie small balance, no sup, and you'll end up going back to the original lender for the supplemental loan. You won't have to go out and shop it to find somebody. They'll only let the original lender originate that second mortgage.
Got it. Thank you.
Awesome. Thanks,
Yes, sir.
Jordan. Great question. We go to the next one. Hey, August, good to see you. Connect with August on LinkedIn, and you guys use the chat too to connect with each other and stuff. This is, let's communicate there as well. But I would definitely recommend people connect with August. Great resource there. Is it Tene? I'm not sure if I'm pronouncing that way. Tene Williams, do you want to ask your question about bridge loans or bridge lending?
Hi, thank you. Yes, I appreciate it. And thank you for the invite. I just registered working with Bethany LaFlamme. So
welcome.
yeah,
Great to have you here. Thank you.
great to meet you all. So yeah, I have a condo conversion we're going to do on a hotel in Manhattan. We'll have the accepted LOI sometime this week. And we're looking for a bridge lender on it. And I have a mortgage background. So, I have a lot of contacts already, but this is a new space. And one of the things I've run into is people saying, oh, is it union or non-union? And I say it's union, and they go, oh. So that's one. So taking any referrals on that. And then we are doing, we have an accepted LOI on a property, 116 unit in South Carolina. So looking for a bridge lender on that. That's a fixer upper. So 116 units. It's all fully occupied. I think it's 95%. So we need a bridge on that.
Tene, I'd love to be able to talk to you a little bit more about that project, because that's a really unique scenario that we see a lot. It's stabilized occupancy, but you want to go bridge with it. And so this is what I really want to do, a deep dive into your strategy, because the whole point of this call talks about exit valuations and your exit strategy. And that is the perfect storm for making sure that you don't have an issue on your exit.
Okay.
Right. So I'd love to be able to connect with you, and I'm a broker, so I can definitely connect you with the right lender. And
that's fantastic. Yeah. So I'd love to take your information. I guess if you could put it into the chat, I'll give you a call first thing in the morning.
Yep, that would be wonderful.
You can put it in the chat, and then obviously at the end we'll make sure everybody can get a hold of
however you want to do it.
Eric. Yeah. Thank you, Tene. Welcome to the show. Raj is in the house. Hey, Raj, how you doing? You want to ask your questions about, not actually following this, can you spend a couple minutes discussing what we're doing with caps these days? You want to ask your question, Raj?
Yeah, sure. Hey, Eric. So one of the things that's happening is we are in the middle of a purchase. The CLO market is blowing up. Of course, we have a bridge going on where the execution is CLO. Spreads are widening. On top of that, we have to buy caps. Buying a cap when the Fed fund rate is already 2 is meaningless unless you buy a cap which is 400 bips, right? You don't buy insurance when the insurance cost is the cost of building the house. So most of the lender docs, and they are very, very, very finicky on this. One, my personal belief is that most bridge guys are pricing in stuff because they don't want to do loans. Our going in is going at like 7%. If I bake in the cap cost, the spread, and then Fed fund rate. So actually more than 7. So have you seen one thought that comes to mind is, why don't you buy a cap which is deep in the money? You buy a cap which is like 50 bip strike. So have you seen like people doing that, or what your thoughts are on that? Like you got the question, right? Buying a cap for 250 strike, which the lender wants you, when Fed fund is 200 bips with the forward curve at 3, is meaningless. So what have you seen people do, or what do you suggest?
And Eric,
Dan, well-
Eric, before you answer that, maybe can you just kind of explain a little bit? Just I know there's some syndicators who are just starting and just want to make sure that we all understand what we're talking about in terms of buying caps on some of these variable rates. Can you just maybe spend 20 seconds on that before answering the question, so we don't leave anybody behind?
Sure thing. We right now with these bridge loans that we're talking about, most of these lenders, they issue variable rate loans, and the rates can change monthly. So they require that you purchase, and for lack of a better term, let's just call it an insurance policy. It's a rate cap that says, if your interest rate increases more than, say, 150 basis points to 200 basis points over your start rate, that this policy will kick in, or this rate cap will kick in, and they'll reimburse you for any amount over that, right? So that means that you've got that much of a margin that your rate can increase before you're reimbursed for the difference. So you buy a rate cap to protect your upside, or your high side risk. Now, the value in that for a lender is obviously they know that rate's not going to run away from you, and it's also there to protect you. So it protects both of you. I think Rajan's question was the feasibility of it and the expense of it right now, because the folks that are issuing those rate caps, you know, they're expecting them to get hit. So what he's saying is, look, if we're planning on this, why don't we just buy a lower strike? When I say strike, that's the point where the rate cap actually kicks in, right? So if you buy a rate cap with a 150 basis point strike, that means that if your interest rate increases by 1.5%, then that rate cap will kick in, and they'll reimburse you for any amount of debt service over that. So I think Rajan's point was, I'm spending all this money, why don't I just buy a 50 basis point strike so I know it's going to kick in right away? Let me start using that thing. And I get it. I see what your point is. The cost of that, I think, would be counterintuitive to just doing a fixed rate loan. And this is a point that I wanted to make and talk to a lot of folks about, is let's conceptualize this. You have a variable rate. Right now, variable rates, you're going to see them anywhere from 6 to 6.5. That's kind of where the market is. If you really got one at a lower cost, you might be at 5.75. But let's just call it 6. And you're going to pay, I mean, you can go to any one of those web rate cap calculators and figure out what you're going to pay. You can go to Pensford. That's a great rate cap calculator. And I think Chatham's a solid one as well. But Google it, and those are two of the ones that pop up. So you do the variable rate, let's call it 6. And then depending on your deal size, strike, duration, let's say you pay $400,000 for that rate cap. Well, what you have to keep in mind and dial into your underwriting is that you just bet 400 grand that rate's going to go up. And yet most every syndicator will only underwrite their start rate for their debt service for 3 years. You just bet 400 grand it's going to go up, but you're going to maintain that 6% in debt service for the entire 3 years. Well, what I would ask you to do is step up your rate year over year, so you at least have some practicality in what you're underwriting for your debt service, and see how it's going to impact your net cash flow. And then compare that to a fixed rate, which is probably somewhere around 7 to 7.25. Use 7.25 since we're using 6% for the other. It's 7.25 from day one, and you don't buy a rate cap, and you know where your rate's going to be, and you just plan your work and work your plan. see how those two work together and which one produces better returns for you. Because again, the only reason that you're doing this bridge loan, hopefully the only reason, is because it's a value add play, right? Because the common response to this scenario is in that first year when the deal doesn't cash flow that well. Well, that's why the reason it doesn't cash flow that well is because it's a value play. It's not a stabilized asset that you're looking for cash flow for your investors from day one. It's a value play. Once you complete those renovations and you talk to your investors about how it might be year two or well, hopefully year two, when they start to see some dividends, that is what a value play is. So that's kind of my overview on a variable rate versus fixed. I asked you to compare the two because I think there's some value in that fixed rate option.
Raj, you have a comeback?
Yeah, so I get that, right? So the point here is more, you can sell a story to the bridge guy, right? Like you call it a value add, you call it a story. The proceeds are always favorable. On top of that, execution is faster. So I get that fixed rate is coming in very attractive. Yes, you take a little bit of hit on the proceeds. I mean, significant hit, but you can work around, because I'm with you on that most of the bridge guys anyways are going to screw you up in 2 years because you don't have an exit at the prices you're going in. So your only exit was somebody coming in, paying a lower cap and getting a more aggressive lender and buying you out, which is not going to happen for 2 years. My problem here is I'm already in contract in a deal which needs to close in 2 weeks. So I don't have the luxury to basically drop my proceeds from 74% to 56% and start the process right away. So I think we're going to take a chance with basically going the bridge route, a slightly expensive debt, figuring out an exit strategy. I'm at this point just trying to figure out why would I buy it's like buying an option at the money with very high vol. So that's what an interest rate cap is, right? So if Fed fund forward curve is 300 bips, why should I buy a 250 bips cap? Why not just buy deep in the money? At least I'm not paying anything for the optionality. So you see my point. Like I can give you some example numbers. So if I buy
Can I jump in real quick?
cap, yeah, sure, go ahead.
Just a real quick clarification. When I used the term fixed rate, I'm talking fixed rate bridge. So you shouldn't see that much of a ding on your proceeds. Now, if you went perm fixed rate, yes, you're going to see a ding on your proceeds because your cash flow is not there. I'm talking fixed rate bridge. So they're still using your exit debt yield and all your exit calcs and going in formulas.
Okay, so we haven't really explored that route. But I still don't think I have the luxury to change the loan product so much late in the game. So I'm just trying to figure out at this point, should I spend $700,000 on a cap, which is deep in the money, or 1.2 million on a cap, which is at the money, where I'm paying basically, if I do the math, it just makes sense that in a very high vol environment, when you know rates are going to go up, just buy something deep in the money. So I just wanted to talk to a few people to see what are other folks doing.
I haven't heard anybody with the latter strategy of going to buy it deep in the money like that, but I see your point, and I think it has everything to do with putting it through your spreadsheet, comparing the cost of funds of raising that million, and seeing how the numbers work out, and just let the formulas decide, because it's all up to pricing, and you know how those rate caps, the pricing changes on it too.
And there's also there's also a huge assumption here about trying to guess what direction, the Fed funds rate or the mortgage rates are going to be. I mean, Raj, maybe we need to start listening or hanging out with some of those folks that think that the Fed funds rate are actually going to start turning around here pretty soon and go in the opposite direction, because that would obviously change change your strategy, right? So, I mean, obviously you're making a call on macro, but who knows where the Fed funds rate's going to be, in the first quarter of next year. Is it going to be where it's projected, or is it going to be lower, or are they going to start cutting? Like, who knows?
And we're not pulling. The other thing is we're not pulling off the Fed funds rate. Fed funds rate impacts consumer credit, but it's not in lockstep with our borrowing indexes. Or indices. I'm sorry.
Yeah.
So there should be some leveling off. It's not expected to continue at this pace indefinitely, right? It's expected to move up until it starts to cool things off, and then hopefully,
yeah,
have a soft landing, right? Knock on wood.
Sounds good. All right, Eric, I'm going to move on because I got a couple more questions here. So, Raj,
okay.
Great question. Appreciate you hopping on. Good. I didn't see you this time, but good to hear from you. Steve Breton's in the house. Steve, you wanna unmute and ask a question?
Hey, Mauricio.
Any question from Steve is going to be a good one. What's going on, bud?
Be kind. Yeah, thanks, Eric, for all the information. And actually, the question I asked was literally, I hit enter and Mauricio said it out loud about your thoughts around the Fed turning neutral to dovish by Q1 or so, and that rates might be right where they are today and potentially even declining from there a year from now.
It's entirely predicated on the response of the economy. I mean, that's what caused it. That's what's going to quell it, right?
Mm-hmm.
We've just got to see how this responds. A lot of what we hear in the news, like take these layoffs, for instance, right? The huge layoffs, the massive layoffs that everybody's talking about right now, e-commerce, tech, mortgage business, that type of stuff. It's fragmented. It's fragmented. It's not the economy as a whole. So I think this leveling off of rates, it can't continue at the pace that it's been going at this year. We know that. So I think it makes sense that it's going to level off. Where? At this point, we just look at the forward curve and take those estimates, because nobody really knows, because it's all a function of the organic economy.
And what's going to break, and when is it going to break? Because I think that's it's inserting my own personal beliefs here, but I think the Fed continues to rate until something breaks. Maybe credit markets, something happens in the credit markets. But but my point to Raj, my good friend Raj, was just there is that prediction. I think there's certainly no assurances that it's going to be one way or another. There are people taking both sides of that bet, and so that has to be factored in. And that's just another risk that we would disclose to investors as well. Let's keep that in mind as well. Eric, you mentioned something really interesting, by the way, before, and I won't keep you too much longer, but if you've got another question, just put it in the chat. But you mentioned something interesting about sort of the vintage product, the 1980s and lower or higher, however you want to say it, and that there's some challenges in getting debt these days on product that's older than 1980.
It's something. I'm glad you reminded me about that, Mauricio. It's something that I have seen on a number of deals. It's something that I experienced Q4 of last year with a deal that I purchased, and that is that the CLO market, the collateralized loan obligation, securitized bridge lenders, these B buyers, the secondary market is really not looking for 60s and 70s vintage assets. So it forces us to move to balance sheet lenders that hang on to their own paper to get those done. Whether it's a regional bank or whether it's some type of fund, that's where you're going to get those older properties done, because the securitized lenders, they're really out of favor.
Christopher's asking. Yeah, go ahead. Finish up. Sorry, finish up.
No, I was done.
No, I was just saying Christopher just has kind of whether that also applies to industrial class B assets. It's kind of a specific asset class, but does that also, are you seeing the same thing with class B industrial?
I haven't tested the waters within the industrial market. Everything I've done over the last few years has been primarily multifamily, especially on the bridge side. I mean, we've done some stabilized commercial. But on the bridge side, it's been all multifamily, and that's where I've seen it. So I really can't give you on the industrial class B assets. I will say, just as an expectation, that if it's a B asset, if it's a true B asset, and the specialty build out is there, then I feel like we're going to be able to get those done, you know, because they don't have the same type of maintenance structure and actual foundation building structures that we do in multifamily.
That's great. And I'm going to repost. I know you posted up there. I'm going to repost your contact info in the chat if somebody wants to grab that. But I don't want to keep you too long. I know you've already spent all day today in Orlando presenting for other folks, and I really appreciate you hopping on. And after, I mean, it's already 8 o'clock in your neck of the woods, so I appreciate it. How can people get a hold of you? What's the best way? I know the contact's there. Is that the best way? Your email and your phone number? Is that the best way for people to get a hold of you if you want to find about more?
That's great. Yeah, that's my cell phone. So you shoot me a text. That's my email. Feel free to do that. I really like to kind of hop on the phone and have a 30-minute initial consultation and learn more about my clients' investment strategies, so that, but that I like to do that before I start to give any type of advice or opinions on what the right debt structure is, because I've got to listen before I can, give any kind of opinion. And so if we can do that, sit in the phone, talk a little bit, then love to be able to talk loans and strategy and put something together for you.
I love that. And don't forget, you're also a real estate syndicator, which is huge. I think always you want to look at your professionals, whether you're CPAs, your attorneys, are they involved in real estate, and specifically here, real estate syndication. That's great. Eric, I'm going to let you go. I'm going to stay on for a couple of minutes in case anybody has any random syndication legal questions, as I always like to do. And Eric, you're welcome to, hey, if you have questions to ask me, I'm happy to ask those too. But really, really appreciate your time, Eric. And hopefully I'll see you again. I haven't seen you in a while. We used to run into each other quite a bit, and it's been a while since you and I have actually seen each other in person. So thank you again, my friend. I know we all appreciate your time, and I'll stick around for a little bit if there's questions. If not, Eric, we'll see you soon.
Sounds good. Mauricio, thanks so much
buddy,
for having me. I really appreciate it. Thank you.
Appreciate it, my friend. I don't know if we have any questions or not, but I'll stick around for a few minutes. And if you do, just raise your hand or something, and I'm happy to answer any legal questions. I know we did an AMA last week, but and I do them every week, obviously. So we can always do next Tuesday. But if you've got something on your mind right now, let me know. Here we go. Nick raised his hand pretty fast. Nick, you're on.
Hey, Mauricio, how are you?
Good, buddy. How you doing?
Good. Hey, Mauricio, I've got a question. I've been looking at some deals to invest in, and I've recently been seeing, and I don't know if it's a trend, a lot of these syndicators are holding reserves in their property bank account, and then they use those reserves. You notice on the financials, they use them to pay out distributions.
Interesting. Yeah.
Now, I understand reserves being held at the lender, which I feel a lot safer. But when a sponsor holds onto reserves, it makes me uncomfortable.
Yeah, and it should. I mean, so I've got a couple of thoughts on that. So we do have clients, especially on, again, value add that doesn't have, great cash flow from day one. And so maybe they want to hand off, I don't know, making this up, 7% pref, right? But it's not going to produce 7% pref. So whatever it doesn't produce, they want to take it out of reserves. So they're almost like they're over raising in order to get that preferred return the first couple of years. That's okay as long as it's disclosed, right? So that's the key. That has to be disclosed in the documents that, you'll be getting a preferred return of 7%. And in the event that, there's no sufficient net cash flow from the property to get to that 7%, any deficit will be taken from reserves, for example. So something like that would be fine. Some people like it, some people don't, but at least you're covered because you've disclosed that that's what's going on. What you want to be careful about is if you've disclosed the reserves are being held for whatever reason your reserves are there, which by the way should be held in a separate reserve account, right? You should not be commingling your operating account with your reserve account. If you start taking money from the reserves, that's something that you're going to run into issues because you haven't disclosed that. Not to mention that with your reserves account, you've got to be really careful. Although this would be after your disclosures, but that's not really a cash on cash return. So you got to be very careful about disclosing that as if you're getting an 8% cash on cash return. That's not really true because all you're doing is really returning their original capital. So that's a cash flow distribution, but it's not a cash on cash return. So those are really the three things that pop into mind. Number one, you absolutely should be disclosing that in your syndication, in your PPM docs, that you may pay out of reserves. Number two, you should definitely have separate bank accounts so you don't want to commingle. And number three, just be careful especially if you're on the front end and you're actually pitching the deal. Don't tell people you're going to be getting a 7% cash on cash return if what they're really getting is a 3% cash on cash return, and then the balance just comes out of their own returned equity.
Got it. Thank you, sir.
Of course. Great question. 10A. I see hands raised here.
I guess I have too many questions today.
No, you're good. You're welcome. This is hey, you get the privilege of your first time being on here. So go ahead.
Yes. Okay. So I new to syndication, and I'm trying to Alan Cowgill. So I'm taking mentorship from Tyler Devereaux and the team, and I could ask this question. However, I am also working with Alan Cowgill. I don't know if you know Alan Cowgill. Okay, he's an older guy from the older school, and he teaches syndication and private money raising as well. However, he's coming from that 1 to 4 family space where he's compiling investors to pull them on a mortgage. So when you're doing, so the question is, when you're doing a 506C, you're not, well, I already know that you're not compiling them for debt, to do a mortgage debt. However, can you, or is that completely separate? Is that a different filing exemption?
When you say debt, are you talking about these investors signing on the loan sort of as a guarantor, like a key principal, or are you talking about actually issuing debt as the form of investment, meaning that the debt's not coming from a traditional lender, but it's coming from investors?
That's correct. The last part.
The latter.
So,
okay. Yep.
Right. So yeah. So it's basically pooling investor funds and then doing a mortgage. And
yeah.
Yep.
Yep. So the first thing you got to recognize is that, debt is a security. So just because you're doing something in the form of debt doesn't get you off the hook of, well, now I'm not really raising capital. I don't have to, I don't have to comply with security.
Oh, no, I don't think that at all.
Okay.
I'm just wondering if that's still, because I'm doing a 506C. So I'm just wondering if that's still something under that same regulation. And
yeah, well, actually, it could or could not. If your main deal is I would structure those differently, right? If I'm doing are you also doing an equity raise, or is it purely a debt raise? Yeah. So you could theoretically have two separate, those are kind of could be two separate syndications. One is that you're raising the equity to go get your down payment and your value add and all that stuff under 506C, for example. And maybe you have 3 or 4 really close friends that you've got a pre-existing with, you've known them for years, and they're going to put in the other part of the capital stack, which is the debt. And maybe that's a 506B, or maybe that's not even a security. If it's a loan that's secured in first position, maybe assuming there's no other mortgage lender on there, that potentially, but I would do a separate analysis between the two. Now, I have done deals where we just incorporate everything into we kind of all put it together and say, hey, look, we're raising $1 million of equity and $300,000 of debt, and we have it all into one offering, or at least one PPM. Obviously, the debt's not going to be signing the operating agreement; they're going to be signing a loan agreement. But I would treat those separately. And so, just because you're doing a 506C on the equity doesn't mean that you have to be doing a 506C or any other exemption on the debt. You could be doing that under a completely different exemption, or vice versa.
Okay, but you have done it where you could, because my general thought process is I'm raising and say I'm raising, 20 million. So now I can, talk to the attorney about writing into the PPM. Okay, well, we want to offer, you've got your 7% pref over here, but we want to offer investors the opportunity to have a more secure debt, and come in as a first lien holder.
Yeah, as long as it's a first lien holder. I mean, Eric is still here, and obviously, if there's already a lender in place and you're trying to do sort of the bridge, the lender may have some issues if you're trying to put a second.
No, I mean,
but if there's no lender, there's a couple ways you could do it. Actually, one is having a completely separate debt raise where you're literally issuing promissory notes at some 10% interest or whatever interest rate you're going to give. A lot of people are actually simply, it's technically equity, but it acts like debt in the sense that they're actually creating a separate class of membership within the syndication. So for example, instead of having just Class A for your investors. You would actually have sort of Class A, let's call it Class A1. And those equity investors just get a 10% flat preferred return ahead of everybody else, and they don't get any of the upside. And then your Class A2 are the rest of your investors, and they get the 80-20 or 70-30 after that Class A1 gets their 10%. So it acts like debt, even though technically it's equity. And I always think that one of the benefits of doing that, especially if you have a longer hold term, is that if you're a Class A member, so you're an equity owner, even though it's acting like debt, you are an equity owner, and you should be getting some depreciation benefits that you wouldn't be getting if you were doing it as debt. Obviously, debt, you're not an owner, you're just getting straight, there's no ownership. But if you incorporate it through the LLC, those tax, benefits, should, now again, there's recapture and all that stuff, so you'd have to figure it out. But that's one of the benefits I like of putting it into Class A, or think of it as Class A, Class B, Class C, where Class A just gets 10%, and that's it. No upside, no nothing. They just get the first 10%. And then your Class B gets, let's say, 80-20, and then your Class C.
That's perfect. Thank you so much.
Of course. Great question. Thanks, Tenny. Steve, you're still here. What's going on?
Hey, I know recently you've been talking about doing a 506B for an offering and then switching to 506C midway through. And if I recall you saying at some point that the 506B offering has to be completely completed, meaning everyone has signed and sent in their wire before you can launch the 506C. Is that correct?
Yeah. So yes. So you have to completely terminate the 506. Just so if people haven't heard of this before, so it's a relatively new rule, but now it's been maybe over a year and a half now. But we did a whole episode on that. I think it was our first one. Our inaugural live was on this topic. But back in March of last year, a new rule came into effect where if you started an offering under, in our case, a 506B, which does not allow advertising, so you fully comply with 506B, meaning you take, there's no advertising, there's no general solicitation, you generally have a pre-existing relationship with everyone, you limit yourself to 35 non-accredited, completely rely on that. And then at some point you want to pivot or switch and start doing a 506C, you can do that if you completely terminate the 506B offering. Let's say today, I like to do written consent, so just something that's really clear on the paperwork if you ever got audited. So I would just do a resolution or a written consent saying, hey, as of July 12th, which is where we're recording this, we decided as a group that we're terminating a 506B offer. We will no longer be accepting monies or really affecting investments under the 506B. And starting tomorrow, we're gonna start accepting monies under 506C and now comply fully with 506C, meaning accredited investors only, taking verifying and making sure that they're accredited, taking reasonable steps to verify, and then obviously you're allowed to advertise. And the SEC has said that they will not, what we used to call integrate, they will not combine those two into one, which is what they would have done, a year and a half ago. But again, there isn't a ton of, additional guidance other than the rule, other than it says you have to terminate it. So to me, terminating means you're not accepting any more investors into the deal. And to me, the safest way to do that is just to make sure you've got all your paperwork in, executed. Because, sometimes people commit, or maybe they send the paperwork, but they don't send the money in. It's an IRA and it takes them a couple of weeks. I would, just to be safe, have all that money in the door. So you're no longer accepting monies under 506B. And then you start focusing on the 506C.
So in my real question there is that realistic when, generally we've got 60 days to get a deal closed? Maybe we have an extra 30-day extension, so we have 90 days. A lot of times it's like herding cats, just getting, everyone wired and buttoned up there.
Oh, I hear you. I think one of the points I had there is you want to start early. Like, you don't want to be waiting until your due diligence period is over and you're a go. If you're even considering this, you definitely want to start talking to your syndication attorney even before you're in contract. Maybe you've got your LOI accepted and you're kind of negotiating your PSA, and that's when you want to make sure it's done, because it is a separate set of documents. For example, it's virtually the same. It's very similar documents, but it is, your business plan is going to be updated, because now let's say you were raising 10 million and you raised 4. Well, now you're not raising 10 million, you're raising 6 million, and we've got to disclose that we've got a bunch of non-accredited. I mean, so it's a slightly different business plan. And then there's some additional language that we typically put into a PPM that addresses the 506C, because it's accredited only. Not to mention the fact that what I like to do, and it's not, again, it doesn't have to be done that way, but what we like to do is just so that, again, we're just trying to be sort of, and I'm not known as necessarily a conservative one, but I just want to make sure that we're sort of the letter of the law. We actually like to create separate classes of membership. So, and everything's identical, except let's say class A1 is our 506B offering, and then class A2 is our 506C offering. So when we're out there marketing our 506C, we're only selling, it's very clear that we're selling, A2 shares. We're not selling A1 anymore because we've terminated. It's just another way for us to be able to prove if we ever get audited that, no, when I made that post, we were already in the 506C stage. And as you can tell, because I actually referenced, that we're selling class A2 or class B shares or whatever the class you're selling. So it's very clear that advertisement was based on the 506C, post termination.
Makes sense. Thank you.
Yeah, but you're right. It's a time, but we've, and maybe that's one of the reasons we haven't done a ton. I mean, I think we're up to like 10 or 11 now that we've done on that transition. And there's one that we started it and then he raised all the capital, so we didn't have to do it. But yeah, I'm surprised. I thought we would be doing a little bit more than those. It's not like we're doing, 15 of them every month. We probably just done, like I said, I think we're up at 11 or 12 since, I really started talking about this, which was maybe 6 months ago. Well, it's episode 1, so 20 weeks ago. But great question, Steve. Good to see you, my friend.
Thank you. Likewise.
Christopher. Oh, you just connect with Chris. Yeah. Connect with Chris. Anybody else have a question? If not, it's let's go one more if there is one. If not, we'll call it a night since it's already bottom of the hour. So I want to respect everyone's time and really appreciate you guys accommodating. I know it's I would have loved to continue doing these on Wednesdays, but my daughter takes priority. So we'll switch these over from to Tuesday. So moving forward, it'll be every Tuesday at 4:30. And always do a little AM. And again, I see Eric is still here. Thanks again so much, Eric, for sticking with us and giving us your valuable time, especially with all the stuff you're doing on. So thank you, Eric. And thank you, everybody. And hopefully we'll see you next week. Thanks, everyone.